Welcome back to the Deep Dive. Today, we're digging into something that hits close to home for a lot of us. The Federal Reserve's recent decision to cut interest rates. What does this actually mean for, your money, your job, the whole economy?
Exactly. So on September 17th, just recently, the Fed cut its main rate, the Fed funds rate, by a quarter percentage point. That brings it down to the range of 4.00% to 4.25%.
Okay, quarter point, down to 4.00 to 4.25. And this was the first cut in a while, right?
Yeah, the first one since back in December 2024, and they said it was because of a, quote, shift in the balance of risks, which really points towards concerns about the job market.
Shift in the balance of risk.
Yeah.
Okay, that sounds like typical Fed language for something's up. They don't usually make these moves lightly, especially when inflation has been such a headache. So what was the real trigger here?
Well, the big one was definitely a weakening we saw in the job market data. Remember, the Fed has that dual mandate: keep employment high and prices stable. And the Labor Department, they dropped a bit of a bombshell. They revised job growth down by 911,000 for the year ending March 2025.
Wow, 900,000 fewer jobs. That's a huge revision.
It is. And on top of that, the August jobs number came in really low, only 22,000 jobs created. So the Fed saw that and said, okay, the downside risks to employment have risen. They had to lean towards supporting jobs.
Right. Makes sense. But like you said, inflation hasn't exactly disappeared.
No, it hasn't. They acknowledged it's still somewhat elevated. Core CPI, which strips out food and energy, actually ticked up in July to 3.1%, and their target is 2%. So, yeah, still above where they want it to be.
So they're acting on the job weakness before it becomes a massive problem, even with inflation still lingering. Okay, let's bring this down to earth. What does this mean for you listening right now, your budget, maybe thinking about a big purchase?
Well, for some folks, there might have been a pretty quick, tangible benefit. Mortgages, for example. Realtor.com noted that this Fed easing helped push mortgage rates below 6.5% for the first time in almost a year.
Below 6.5%.
Yeah.
Yeah, that can make a real difference if you're looking to buy a home or maybe refinance.
Absolutely. It means lower monthly payments, potentially makes buying more affordable. And, it's not just mortgages. Lower rates can eventually filter down to things like car loans, maybe credit card rates, business loans, too.
Okay, so potential relief on borrowing costs.
Yeah.
But moving beyond our wallets for a sec, how does this fit into the bigger economic picture? What are people forecasting now?
It's interesting. The market reaction was kind of mixed. Stocks went up at first, bond yields dipped, which you'd expect with a rate cut. But then things wobbled a bit because Fed Chair Jerome Powell sounded what some call mildly hawkish.
Hawkish, meaning not quite ready to promise a whole series of cuts.
Exactly. He called this cut a risk management decision, not necessarily the start of a big, long cutting cycle. Look at they're hedging their bets. And you see that division within the Fed itself. Their own projections, the famous dot plot, show the median official expects maybe 2 more quarter point cuts this year.
Okay, 2 more cuts by year end is the middle ground.
Right, the median. But some officials think fewer cuts, or maybe even none more this year. And one actually wanted a bigger cut this time. So there's definitely some internal debate about the right path forward.
And then there's the whole global situation, right? The U.S. economy doesn't exist in a vacuum.
Very true. International factors add another layer of complexity. For instance, an analysis from the Bank of China suggested the U.S. might face a risk of stagflation short term.
Stagflation, that's the nasty mix of slow growth and high inflation, right?
Precisely. High inflation, rising unemployment, slow growth.
Yeah.
It's a really tough spot. And that analysis partly linked the risk to the effects of trade policies, specifically mentioning former President Trump's tariffs impacting confidence and trade flow. So you have these global uncertainties mixing with the domestic inflation and job market picture. It makes the Fed's job incredibly tricky right now.
Wow. Okay, so putting it all together, this Fed rate cut, while maybe offering some immediate relief on borrowing costs like mortgages, is really a move made against a very complex backdrop. You've got slowing jobs, sticky inflation, and global question marks.
That's the crux of it. It directly impacts your financial world, from loan rates to job security. And it really leads to the big question we should all be watching. How will the Fed keep balancing these competing pressures, jobs versus inflation, domestic versus global? How will their next steps continue to shape your financial decisions? And really, the whole American economic landscape in the months ahead. It's definitely a situation worth keeping a close eye on.